Recently, many of you have asked me about Singapore banks. DBS, UOB, OCBC, they're all trading at record high levels. So really, what should I do now? Should I buy more of these shares? Should I hold on to them? Or if I have shares right now, should I sell them? In this video, I'm going to explain to you using two very simple rules that you can follow in order to analyze and assess some of these bank shares. So let's get down to it. Now, if we look at Singapore banks and if we look at stocks, what we want to understand is that when we invest in stocks, we are actually buying part ownership of a business. This means that you want to treat stocks not as pieces of paper, but rather you are a business owner trying to invest in different businesses. And what we are looking out for are business fundamentals. Business fundamentals means that whether the company continues to grow its revenues, whether the company continues to grow its profits year after year, and more importantly, these profits must be predictable. So predictable means that over the last few years or the recent quarters, the profits continue to grow. So this is the first test which I want to look at. Now, the second one, which is more important and often traps most investors, is looking at the right price level. So this tells me when to actually buy or sell these high quality companies, high quality businesses. Essentially, it's looking at the valuations. Now, for banks, for Singapore banks, the metrics which I will use, one simple indicator which I will use, I'll share it with you later so that it can give you a much better, much easier picture, right? So let's get down to looking at the first step first, looking at the fundamentals and what's really driving the Singapore banks. So we see that all three banks, including DBS right now, is all trading at an all-time high, right? DBS you see now is about $76. And this is one of the highest, in fact, this is the highest today which we have seen. And you can see this was really because of its latest second quarter results. In fact, DBS has recently raised its 2026 results guidance because of its wealth business. So management is right now firing on all cylinders after its record profit in the quarter. If we dive in deeper into its financial statements, looking at its presentation slides here, DBS recorded a first half income and earnings. It has hit a record high for its second quarter results. And if you look at the highlights, DBS second quarter net profits was up 9% year on year to hit a record $3 billion. Its return on equity, its ROE, is about 18%. And what is driving these profits is coming from wealth management. This big momentum is because Singapore is still a financial hub. And we know that because of the Middle Eastern crisis, we know that over the last couple of years, China was in a bear market. This has resulted in all the global capital, right? All the rich people's money is all flowing into Singapore. And DBS, being the biggest bank in Singapore, is able to capture all these assets, of course, including OCBC and UOB as well. And more importantly, if you look at the fundamentals of these banks, we know that they are a safe haven to put our money, right? I wouldn't take out all my money today to park in some random digital bank or some random overseas bank. I would personally still put in any of the three banks. I would still put in DBS. Why? Because they have a long-standing reputation and they are considered safe, right? They have a very, very strong competitive advantage. There's no other financial institution which is able to take down any of these three banks. So if you look back at the first rule, we want to look at the business quality or the fundamentals. And the three Singapore banks, if you see DBS especially, it has done really well in its latest quarter. Now the second rule which we want to look at is the right price level. Now, how do we determine the right price level or the valuations? Now, for Singapore banks, because it's considered a financial business, it's a financial institution, how I will value it is using a simple ratio called the price to book ratio, right? The price to book ratio basically tells me it's like the temperature, it's like taking the temperature of a stock. If the price to book ratio gets too high, it becomes very hot and you don't want to touch something which is really hot because it gets very dangerous and you might get burnt. But rather you want to pay a modest price for the stock itself. So you want to actually pay a right price for its price to book. I'll share with you later what is the right price to look at. So price to book basically takes the share price of a stock, divide by the book value. The book value is the net worth of a company. So you take the assets, all the assets today, you minus off the liabilities, what the company owes. This is the equity or the net asset, which is owned by the shareholders. So in this case, if we look at DBS here, so let's take a look at DBS. So DBS net assets here is roughly about, its total equity here is about $70 billion. Its book value per share is roughly about $24. Now, why do I use the price to book? It's because it's considered a financial asset. If you look at Warren Buffett is the greatest investor of all time. And what he really knows, right? If you see his skills, he specializes in knowing how to value businesses. And when he buys back Berkshire Hathaway shares, Berkshire Hathaway is essentially an investment company, and it's mostly made up of financial assets. So Warren Buffett actually used the book value to determine when to actually buy back the shares and also value his own company. So if you look at Berkshire Hathaway's owner's manual, it's very interesting because one of the sections, Warren Buffett did put how he actually assessed Berkshire Hathaway, his own investment company's valuations. So he says here, we give you Berkshire's book value figures because they today serve as a rough, albeit significantly understated tracking measure for Berkshire's intrinsic value. In other words, the percentage change in book value in any given year is likely to be reasonably close to that year's change in its intrinsic value. Right? So this is actually very important because even though it's hard to guess accurately what the intrinsic value of a business is, but we can estimate using the book value. This only applies to financial assets. That means companies which owns a lot of financial assets. We know that Berkshire for the last 30 years is essentially an investment company which buys into stocks, bonds, and it also owns an insurance business. And insurance business, it owns a lot of financial assets as well. So Warren Buffett, the right metric for Warren Buffett to use to buy back his shares, when to buy or when to hold or when to sell the stock. So very simple, we track the historical price to book of these Singapore banks. I'll give you one example. Let's take a look at DBS, right? So you can see that DBS, historically, DBS price to book trades at about 1.4 times book value per share, right? 1.5. So this was over the last 20 years, close to 20 years or so. And the highest it actually went, right? Last time was actually during the global financial crisis here. And back then, the market was actually trading at about 1.8, 1.9 times. So this tells me that on average, the market or investors would actually pay 1.5 times the book value of DBS shares. That means 40% more than its book value. DBS book value right now is roughly about $24. Right? So on average, investors will pay about 40% more. And that's how you determine the price at which you would pay. Now, the highest it actually went, right, last time was close to about 1.8, 1.9. So investors would pay close to double the book value of DBS. But you can see here, right, over the years, the price to book will always move in different cycles. There'll be some years where the price to book will go up. There'll be some years where the price to book will go down. So it moves in a cycle. Why? Because the market knows, right? The market might be emotional, right? Sometimes it's happy, sometimes it's sad, but the market is not dumb. It knows the value of these businesses over time. That's why the DBS shares will actually move in cycles. And what you want to buy, when you want to buy, is when it's trading below its book value, right? So there are times when DBS actually trades below 1 times book value. You can see that here in 2009, 2011, 2015, 2016, 2020. Now today, the price to book of DBS shares is trading at 3 times price to book. So what this means is that DBS book value is $24 per share. That means today, the market or investors, they are paying almost 3 times because the book value is $24, but the share price today is about $75, $76. That means today, investors, the market is paying almost 3 times the book value of DBS shares. Now, is this something which is a fair price to pay? If we look back at Warren Buffett typically pays somewhere around 1.1, 1.2 times book value. Now, he did buy Berkshire shares when it was trading about 1.3, 1.4 times book value. So it really depends on the stock market. This tells me that Warren Buffett would only pay up to 40% more than the book value of Berkshire Hathaway. And Berkshire Hathaway is a very strong compounder. It has been generating a lot of returns for Warren Buffett. We look at DBS today, right? It is a strong compounder, but is it a very strong growth stock, right? Is it investing like any other tech stocks? My answer is no, because DBS is still a very traditional business. It's a savings and lending business. It's a very traditional banking business where it borrows money from, it takes depositors' money and it lends out as loans to corporates, to individuals. So in this case, if I were to follow how Warren Buffett analyzes his Berkshire Hathaway's valuations, I would actually pay around 1.4 times book value for Singapore Bank shares, right? So in this case, the average price to book ratio is roughly about 1.4 times, right? Then you might ask me, hey, really, when is a great time? Then when is a good time to buy some of these shares, right? Do I have to wait forever just to buy the Singapore Bank shares? Because it seems like it's never going to happen. Now, if you look historically at DBS shares, right, there are definitely times when the shares actually traded below its average price to book ratio. One time in 2009, 2011, and then 2015, around 2015 to 2016, price to book started dropping. And then, of course, COVID also 2020. So there are actually opportunities to pick up some of these bank shares. For me, because I invest in a diversified portfolio of stocks across different countries, different stocks, I wouldn't necessarily just buy Singapore banks. So if Singapore banks are expensive, then I would just buy into other sectors or other stocks while waiting for the prices of these bank shares to drop. This is what I would do as an investor. Why? Because don't forget that capital or money will always flow from the impatient investor to the patient investor. And as retail investors, I think one of the strongest competitive advantage that we have versus fund managers and institutions is that we have patience, right? We don't have to manage other people's money. We don't have to manage clients' money. The money which we manage is ourselves. And we decide, right? We can take how long we want to own the stock or how long we want to actually buy or sell the stocks. So we have the patience and it's a competitive advantage. So this is something which we want to use. Now, if you look at OCBC and UOB, right? Let's take a look at OCBC and UOB. OCBC and UOB also reported very strong second quarter results, right? They have beat analyst forecasts, and at the same time, right, it was also driven by the wealth management boom. Now, we look at the price to book ratio for OCBC. OCBC, the average price to book ratio it has traded is 1.3 times over the last 20 years. It has traded right now close to its all-time high, which is very similar to the global financial crisis. So you can see here, it's right now trading at a similar level. So the temperature of OCBC, the temperature of DBS is at a very hot stage. And you want to be careful when you are touching something hot because you don't want to get burned. If we look at UOB right now, right? UOB is slightly different. You can see that the average price to book is 1.3 times historically. Today is trading slightly higher than its historical average of 1.4 times. It's still very far off from the global financial crisis. Now, the reason why is because UOB is a bit different. The business model is different from OCBC and DBS. UOB focuses a lot more on the traditional loans business. So it focuses in lending out money to companies within Asia. And it doesn't have a very big wealth management business compared to OCBC and DBS. And because of this, the price to book, investors value UOB shares at a much lower multiple as compared to DBS and OCBC. That's why it's still trading, even though it's trading It is trading lower than the global financial crisis highs, but it is much higher than its average price to book of 1.3 times. So if you look at these three banks, how I will actually value these banks is simply using the price to book ratio and looking at the historical levels of this price to book ratio, trying to understand what is the highest price to book which these three banks have traded, and also comparing to how other smart, intelligent investors have valued their own investments, like Warren Buffett, how he has assessed Berkshire Hathaway. He gives a very modest multiple of roughly about 1.3, 1.4 times when he wants to buy back Berkshire Hathaway shares. So this is how I would value all these the Singapore bank shares. So the question now, the golden question now comes is really, would I buy, hold, or sell my Singapore bank shares? So I do own all the three Singapore bank shares. And for me, I wouldn't buy more because it's trading at a ridiculous level today. I wouldn't sell as well. Why? Because I have bought all my bank shares at a very, very cheap valuation many, many years ago. So it has, when you have bought or invested in a stock at a low level, at a low price level or low valuations, then you want to allow it to grow organically. So my dividend yield on my cost of these Singapore banks is at least a double digit. And because of this, then this allows me to collect very strong dividend income. I wouldn't want to sell all these Singapore bank shares. So for me, I wouldn't buy, I wouldn't sell these bank shares right now. And because the temperature, right, the price to book is so high, buying all these shares at record highs today could actually be a bit more tricky for most investors. So if you ask me, I would be patient, and in the meantime, I would rather look for opportunities elsewhere. Right? So I hope this has been a useful session for you. If you like this video, do remember to subscribe, like, share, and comment on my video, and I'll see you next time.